The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren Ingram.
I'm Pieter Villiers from Money Marks.
And today we're going to help you understand what risk is to your investments. So we're not talking about jargon and the like. What we're trying to say is, what are the things that you should focus on to protect your money and to help it grow? And what are the things that you can ignore that are just noise, that are out there for the media machines and the social media influencers and all that stuff? So we're going to understand the things that you should do to protect your money, the things you can just let go, and hopefully get to the end where you're relaxed and calm and successful in your investment career without a huge amount of effort, noise, and very expensive school fees.
Yeah. And risk is such a general term that could be applicable on many things in life. So today on investment risk, what I think we need to uncover is there are different types of risks that all play a role and all can be managed to an extent. So there's volatility risk, which means markets go up and down. There's inflation risk. We need to beat inflation so our money can maintain purchasing power in real terms. There is the risk that you're not reaching your goal, which means you're either not investing correctly, maybe you've got a long-term horizon, but you're too conservative, also a risk. And we get stuff like liquidity risk. You know, you need money in 2 years' time to buy something, but now it's tied up in some structure like a retirement annuity or endowment. So there's different types of risks that we'll uncover and will help you understand what risk you can control, what you can't, what you can mitigate, and to what extent, so that you understand the risk involved. Because oftentimes people think investing in the market is synonymous with taking risk. And yes, that is true to an extent, but it doesn't mean you're just going to lose money if you put your money in the market. That's not true. You need to understand what that potential risk might look like and how you can mitigate that and build a portfolio that can withstand that over time.
So the thing that keeps me awake with my investment, so I have that if I look at my own portfolio, I shouldn't say mine, my wife and our portfolio, and I look at how it's structured, it's very much a classic sort of balanced combination with I think we're about 75% in global stock markets and South African stock market. The balance is split equally between cash, government bonds, and then some property companies, but not many, especially not in South Africa. And when the markets are doing well, I don't get too excited because it feels to me that some of that growth, especially if it's a very good year, the markets go up. We've had years when the JSE goes up 25 or 30%. I know we're going to give back some of that somewhere along the line, and so I don't get too excited about that. Equally, when we see a very big drop in the markets and we're down 25%, I feel exactly the same. When the markets were up 30%, I didn't panic and fall apart with excitement. I feel the same on the other side. But what really does keep me awake at night is the risk that my money doesn't grow faster than my cost of living is increasing. And that's not me spending more on more luxury stuff or more useless stuff. I mean, I do spend I'm sure some of my money's wasted if you ask my wife, but that's not what I'm talking about. I'm talking about the cost of living that rises faster than the growth rate in our money. And that's particularly worrying for people, and that's not me, but for people that are at retirement. When you've got a defined pool of money and that's what you've got, and now your cost of living is going up at 10 or 11 or 12% a year, and the growth rate on your money is only going up at 5 or 8% a year. If that happens over a 1 or 2 year period, I mean, it's not nice, but it's normal. But if you're not tracking the cost of living with your money, that for me is the thing that really keeps me awake. And you and I won't be doing a show saying, Mr. Kamala or Mr. Jones, your cost of living is going up faster. No one's going to give you the news headline for you. Yeah. It's just going to happen. And what happens is 5 or 8 years in, you wake up to the fact that your money just doesn't buy what it used to, and you don't have enough capital anymore. So that really keeps me awake at night. Markets going up or down, I mean, it gives us stuff to talk about, right? We've got a podcast, we've got a show we've got to do, and it's more entertaining than I think it's deeply concerning. unless you make mistakes around investment decisions. But I just think for me, risk is you don't keep pace with the cost of living. Volatility, I don't know. I mean, I don't know if it keeps you awake. For me, it's part and parcel of life. We live in a windy place called Cape Town. The wind comes, the wind goes, the seas get rough, they get calm. It's volatility. That's normal.
Yes. And that's the thing that I also found that when people think about risk, they think about the markets going up and down. That's kind of one that they focus on, but they often forget about the other one, the inflation risk. And, we've got the statistics every year. They say CPI, consumer price index, was 5% or 6% or 4%. It's great to know that because they base it on like different factors that they decide what they're going to include in this comparison. But your personal inflation rate might be more than that. If you know that I used to spend 3,000 Rand on groceries for me and my family, but now this year, I don't know, it's 4,000, and I don't really know that I'm eating anything else. I'm buying the same stuff, but how did this now suddenly increase so much by 33%? Some items in your budget will increase more than that general inflation rate that they always communicate. Stuff like kids' education, especially tertiary education, that's usually like inflation plus 3%. You can add to that medical expenses, inflation plus 4%. You see the medical aid rates going up by like 9%, 10% per year. So be aware of that. If we say inflation is 5%, or they communicate that this year inflation has been 5%, or we even say it's average 5% over time, your personal inflation rate might be more than that. And that is where it becomes a bit important to understand that your increased cost of living needs to be lower than your growth, at least it needs to match after fees and after taxes, all of that. So yes, that's also what concerns me more. That's a biggest risk. And also remember, if you're not investing your money properly and you're just putting it in the bank, you're probably going to pay more taxes and you're not going to get the growth. That means that inflation risk is going to erode the value, the purchasing power of your money, which means you're not going to reach your goal in time. That's also a big risk that I am concerned about, not reaching my goal. So let's say I want to reach financial freedom at 55. I'm not investing properly. I'm not adding enough to that. Probably not going to reach that goal. If I want to send my kids to university in 15 years' time, but I'm keeping everything in a cash account in the bank, either I'm going to have to contribute a lot more, or I'm not going to reach that goal. I won't be able to send them to university. So that's a risk that I think we need to first focus on. How do I reach my goal? And then what do I need to do to reach that? And that sometimes means if we say equities will give you a better return than cash over the long term, but it also means you're going to have to take a higher risk. We refer to volatility risk, short-term risk. Markets go up and down. It's normal. Cash does not have a lot of volatility risk, if any at all, maybe a little bit depending on how the interest rates goes up and down. But it also means that it's going to take you a lot longer to reach your goal because you have to invest more to get there. So that is where I'll always start with is what is the goal that I need to reach and what I need to get there, and what are the trade-offs that I need to face on my way to that goal.
Yeah, and just for context, if you look at stock markets in South Africa over a long period of time, they have a very good history that I don't think will change of beating inflation, growing faster than inflation, of around 4 or 5% a year above inflation. So if you look at global markets, it might be slightly worse than that. They might not beat inflation by 4 or 5%, but it's very close. It may be 3 or 4% in the very developed old markets now. Cash has a fantastic, stable, very predictable history of just matching inflation before tax. So if you love certainty and you go, great, I'm going to put all my money in the bank and I'm going to get the fantastic money market rate because I'm going to earn interest every single day, every single week, every single month, every single year. I'm never going to see a loss. Well done. That's going to happen. What is also guaranteed, certain, I don't make guarantees, but this is an easy one to make. 10 or 20 years later, the buying power of that money is probably half.
Yeah. Yes.
And so your certainty has come at an enormous cost. And the person that had to live with the volatility of markets, they're going to go in 10 or 20 years' time, their money will be worth 2 or 3 or 4 times what it was when they started. And all they had to pay was a bit of up and down. a
Yes.
bit of excitement. And if they didn't check their statements too frequently, that excitement was very little.
Yeah.
And that's it. I mean, it's such a simple concept. I'm not saying it's easy, because it's not fun. When you look at your investments, let's say you've worked really hard, you get to kind of 10 million rands worth of investments. Most of it's in the stock exchange, got a bit of cash, bonds and property, and it goes from 10 million to 7. I mean, it took you a long time to accumulate 3 million rand, and it's just gone over a 12-month period. If that happens, please send your mails to Pieter. Not to me. No. I mean, it's part and parcel of life. So just understand that it's very disconcerting. It's normal. Do nothing and it'll probably recover. And the person that's sitting in cash, that's laughing at you because yours has gone from 10 to 7, 3 or 4 years later, your buying power is way better than the 10 million you had, and theirs is worse. Yes. So I just think like that, we need different words. I mean, like, to talk about volatility and risk in the same sentence, I think the risk is psychological. It might cause you distress, but it's not really a risk to your investments unless they were badly structured to start.
Yes. Yeah. Caveat to that. We're not saying that let's say your portfolio is in a bunch of meme stocks and small cap stocks that you think it's going to go to the moon. That's a different scenario. We're talking about a
that's gambling. Like we're talking about investing now. Yeah.
Yeah. This is proper. Like, you've got a good structure. It's going to happen. And I also think there's a opportunity cost risk. I don't know if that's the term, but if let's say you've got money in cash. Let's say you've now inherited a couple million. But now you're listening on the news and you see like, oh, the market is dropping. I'm scared. I'm going to put it in. Every day you wait, every month you wait, every year you wait, there's an opportunity cost to that over decades that you're missing out. I don't have the specific numbers, but I know that if we look, like, let's say past 100 years, if you only miss the top 10 days of that entire period, if you add all those days together, you are missing on a massive amount of returns in just 10 days, top 10 days. There's statistics around that. Top 20 days, top 30 days. Now, I don't know what those days are. Warren doesn't know. No one knows. But what matters is your money is in the market to capitalize on those things. Because usually what happens, if there's a massive market downturn, it's going to bounce back up. Then it's going to go down. It's going to bounce back up. But over time, it increases. As long as humans exist and we continue to innovate and markets become more efficient, the stock market should go up. That's almost like a given. It might be that some periods of time, maybe a year or two, or even maybe in the worst case decade, it can go down, but it will pick up again. And you want to be there when it picks up. Even if you miss a day or two, that's probably going to hurt you a lot more than sitting on the sidelines. That opportunity cost of not being in the market because you're scared of volatility risk, which is a guaranteed it's going to be there, is a bigger negative effect. And that's why managing your emotions around it is much more important.
So I mean, I agree. I also don't have the exact stats, but what I will tell you is when I've looked at when have been the best days in the stock market history, so the day where you get a 5% jump and the whole stock exchange has gone up 5%, I'm sorry to say it doesn't happen when things are going incredibly well and everything's been going up for month after month after month. What happens is the stock markets fall apart. They've lost 30%. And it feels pretty much like the world's going to end. The media is certainly telling us that the world's going to end. And every commentator's given up commentating and gone and become gardeners. It's pretty much there. At that day, something will happen. For example, the Reserve Bank governor in America will say, we're going to drop interest rates, or the Chinese government says we're going to inject liquidity into the system, or something big happens that's unpredictable, unforeseen, and it causes the entire stock market to become incredibly positive in a not an instant, but a very short space of time. That will be one of the best days in the market. Now, if you believe that you can foresee those things, then you need to be in cash before the time, buy kind of the day before all of these magical events happen, and then benefit from those best days and then sell again. And unfortunately, no one can do that. So the best days don't happen in good times. They happen in terrible times, right when everybody's pretty convinced that the whole financial system's collapsed and we're about to become farmers again as a society. very good periods in stock market history, when markets go up 10 or 20% a year for a 3 or 4 year period, they are not characterized by great days. What happens is the markets go up 0.1% today and 0.1 again tomorrow and 0.2 the next day. And so they're consistently just adding a bit, and it seems like nothing's really happening. It's kind of boring. And then markets accumulate. And so very soon you look back and you go, wow, my whole portfolio is up a heck of a lot, but it didn't feel like it. So the bad days happen right towards the end of a very nice long period when things have gone incredibly well. And suddenly we get, they call it, Black October or whatever, Blue Monday or whatever it is. And it happens by surprise again. Yeah. So by definition, all of the big events happen by surprise. And so I like your point. It's that opportunity cost of not being in markets when things are really bad. The reason you want to be in is because then the good days are going to happen, and those are incredibly rewarding. And actually, equally on the other side, if things are good for a period of time, you want to benefit from that. You want to earn the dividends and all of that. So, I mean, it's a great point. I think it works out something like your returns halve if you miss the 20 or 30 best days in the market history. That's a heck of a price to pay.
And relative to that time frame, if you say 20 days of 100 years, what percentage of that time frame is that small amount? Like, it's impossible to predict. So understanding this whole risk, so then how do we as investors understand how much risk should we take? So there's 3 kind of things that we think about. There's your risk tolerance, how you feel about risk. Now, this usually involves answering a couple of questions on a questionnaire, and then it tells you, okay, cool, you're a moderate or moderate aggressive or moderate conservative. That is how you feel and how you perceive risk to be. Like, for example, if the markets drop by 20% today, how would you feel about it? Most people won't feel very nice about it if they don't understand what the long-term effect would be. But that is something to understand about yourself. What is your perception of risk? Then there's also your capacity to take risk. So if you are young, you're investing for financial freedom, retirement 30, 40 years away, you've got a big capacity to take risk because you can continue investing because you don't need that money. Up through the ups and downs, you invest, you're not going to touch it. If you're saving for travel next year overseas, then don't take any risk, because then it might just happen that you will have to use that money just after a market downturn. So I'm talking about long term. You've got big capacity to take risk. Equally, if you have 5 different investment portfolios and you look at one specific portfolio that's taking up maybe 10% of your overall wealth or net worth, you can take more risk with that specific portfolio because it forms a smaller part of your total net worth. But let's say it takes up 90% of your portfolio, then you might not want to take all the risk in the world. And then there is the risk required. So then that means we look at the term. If it's a long term and we need to have reached this number at this endpoint, then we can do a calculation to say, all right, we need to target this return, let's say inflation plus 5%, and that will dictate the assets that we have to put into the portfolio. So then we need to put in quite a lot of equity and a bit of property, a bit of bonds to get there, and that will then also dictate the volatility risk that you have to take into account. So looking at all 3, risk capacity, risk tolerance, risk required, then we taking all those factors into consideration, then we decide, okay, this is a portfolio that is suitable to reach your goal, but also what you're comfortable with. Because sometimes there's a bit of trade-offs. Maybe you feel like, I don't want to take any risk, I don't understand this, I don't like this, but we know you need to take risk, then we'll meet somewhere in the middle. Then that means you're going to have to be comfortable with a bit more volatility. We'll educate and understand what that means, but it also means that your goal will have to amend. Maybe you're going to have to work a bit longer because you're not going to get the required return that we need because you're too scared of the volatility. I think oftentimes that's more educational thing that needs to come to play. Or it might be that you're like, I want to take all the risk in the world, but you don't need to take so much risk because you're closer to your goal and you don't have to necessarily take on that volatility risk. So looking at all 3 of those factors in combination to then decide on the appropriate portfolio that you'll build.
Yeah, and I think to understand the psychology here is probably the trump card, because someone who's got a very high tolerance for market volatility, if they can live with it, and even if they're in a very good financial position, it might just be good for them to kind of carry on with that volatility. It's not a problem to embrace it. Having a very high allocation to the stock markets, both in South Africa and globally, is a good decision over long periods of time. So as long as your time horizon's long enough, don't worry about it. But on the other side, the person that can't live with a drop of 5%, for them, it's not good enough, for them to say, well, I'll just try and get through with 60% in shares and just try and get through the next. They're not going to. The reality is they're actually going to make a really bad decision right at the worst possible moment. And that's not a reflection of their intelligence or anything like that. It's a psychological hardwiring. You can't have a rational conversation with someone who has a phobia of snakes while there's a snake in the room. It's not going to happen. And that's not a criticism of the person. That's a hardwiring thing. You've got to remove the snake, let them calm down, and then talk to them about it. But the point is, you're going to bring the snake back, they're going to freak out again. And I feel like that about stock market volatility and people who can't tolerate a loss. And so there you have to be careful about how you build your investment. So you might have to say to yourself, I'm going to set aside like a big chunk in very low risk, very conservative investments, and then I'm going to park a portion of the stock market investments in money that I'm not going to look at for the next decade. And all of that risk that happens, it's almost someone else's money. And you manage your psychology that way. At the very least, I think there isn't a person alive. It's a big statement, but I'm going to stay with it. There isn't a person alive that should have less than 35%, maybe even 40% of their money in the stock markets, in nicely diversified portfolios. There might be a handful of very young, very aggressive people that can have 100% in shares on the other end of the spectrum. But for all of us, somewhere along the line, we need at the very least 35% in shares to somewhere around 75%. If you're in that gap, in that middle, let's say, then you're probably okay. You'll need to figure out your own circumstances, but that's the range most of us will be in most of our time. I think Warren Buffett's 100% in shares.
And he's an old toppie.
And he's a toppie, and he's never going to spend the money ever. So he's fine. But equally, he's probably the one guy that could go 100% to cash now, and he'd be desperately unhappy. So for the rest, let's live with that range, 35 to 75%. And if you want to keep things simple, you need to be in that range somewhere. But I think the psychological capacity for risk trumps the other two for me. Just from experience, I've tried very hard to kind of train people to say, listen, I'm going to teach you about stock market volatility. Do you understand your portfolio is going to drop by 15%? And they go, yes, no, we do. And please, like, sign here. Like big red letters. Yeah, okay, great. Middle of the stock market crash, what happens? Sell. I get the instruction: just sell. Sell. I don't care. I can't sleep at night. All of those things. So I think that's the thing that worries me about the psychology of money is if we ignore that, or we make it too small a part of the calculation for people, that actually we do them a disservice. Because the trick is you have to stay invested for the next 20 years. So if you take a little bit less risk, but it gives you the highest chance of staying invested, actually that's okay. And you're right. What that means for you, if you are a person like that, you're going to have to spend a bit less maybe, or you're going to have to save a bit more, or you're going to have to work longer. Work with yourself to know that. It's not a criticism. It's your hard wiring. You were born with it. If you had blonde hair or you had no hair, you were born with it. You've got this tolerance for risk. Education's going to nudge the needle, but it's not going to change the whole.
Yes. And maintaining the plan and the strategy is much more important than maybe hopefully getting a bit higher return, because we're taking a lot higher risk. And it's something that you also learn about yourself over time, because if you started investing when the market went up, very easy because you always see it go up, but wait for the first market crash. I started when I qualified as a vet, was December 2019, and then January 2020, I started investing my first salary, and I had like savings built up over like time as a student that I worked hard for. And then that March, there was a massive COVID market crash. And I lost 30-40%. And, I understood money to an extent. I read Warren's books and I thought I was okay with it, but it still sucks. It's still horrible to see your portfolio like that. Even for us that works as financial planners, if it happens, we also feel it. We also get stressed and we also get concerned. It's a psychological hardwired thing that you can't remove from yourself. but just understanding it behind it. And if it means that, okay, so we'll take a little bit less risk because you're going to sleep better at night, then that's a trade-off that you'll make, and somewhere else we'll fix it. We'll maybe make our goals a bit more realistic, or we invest more or spend less. That's okay if that's going to make you happy. And that's why there's no rule of thumb for everyone to follow. It's looking at all three of those factors and in combination, then deciding what's best for you, and not in just like focusing on one and saying that's the end all be all.
Nicely said. I can't add any more.
Awesome. But thank you so much for watching and listening. And if you have any questions, please let us know in the comments. We'd be happy to answer. And yeah, thank you so much for Sealand for sponsoring the new kits. We appreciate it, and looking forward to the next episode.
And don't forget to subscribe, and we'll catch you again. Thank you so much.
Thank you.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.